Wall Street is entering a new phase of excitement. After years of cautious markets, delayed public offerings, and economic uncertainty, a new wave of mega IPOs is starting to build momentum again. And investors are paying very close attention because some of the biggest private companies in the world are preparing to enter public markets at a time when artificial intelligence, technology infrastructure, and growth investing are dominating financial conversations once again. But while mega IPOs create excitement, they also create serious risks. And history shows that major IPO waves often signal bigger changes happening underneath the market. Right now, investors are watching closely because several industries are producing companies large enough to reshape parts of the stock market once they go public. AI companies, cloud infrastructure firms, cybersecurity businesses, fintech platforms, semiconductor startups, defense technology companies. Private markets have changed dramatically over the last decade. In the past, startups often went public relatively early in their growth cycles. Today, many companies stay private much longer. That means some firms now reach massive valuations before public investors can even buy shares. And that changes the meaning of an IPO completely. These are no longer tiny startups entering the market with uncertain futures. Many modern IPO candidates already generate billions in revenue, operate globally, and influence entire industries before ever becoming publicly traded companies. That's why Wall Street gets excited when large IPO waves begin, because mega IPOs often represent the next generation of growth stories, and investors are constantly searching for the next major company before it fully matures, especially during periods of technological transformation. Right now, artificial intelligence is driving enormous investor optimism. Companies connected to AI infrastructure, cloud computing, automation, semiconductors, and cybersecurity are attracting huge amounts of capital. Private investors have already poured billions into these industries. Eventually, many of those companies will seek public listings, and when they do, markets may treat them as future technology leaders almost immediately. That creates huge excitement, but also huge danger. Because IPO booms can quickly become driven by hype instead of fundamentals. History has shown this many times before. During the dot-com era, investors rushed aggressively into internet-related IPOs, believing every new technology company would dominate the future. Some companies became giants, others collapsed completely. The lesson wasn't that technology failed. Technology eventually transformed the economy exactly as many predicted. Cheap capital made it easier for companies to raise money and invest aggressively in expansion. But as borrowing costs rise, the financial math changes. Companies that depend heavily on external funding or uncertain future growth become riskier investments. Businesses that already generate strong cash flow and maintain disciplined financial structures become more appealing. Predictable businesses are often better positioned to operate efficiently without constant access to external financing. Recurring revenue models are another reason investors value predictability more today. Many of the most attractive businesses now operate with subscription-based or long-term contract revenue structures. Software platforms, infrastructure services, telecommunications providers, and certain industrial companies often generate recurring income from ongoing customer relationships. This recurring revenue provides visibility into future financial performance. If a company knows that a large portion of its revenue will repeat each month or year through subscriptions or contracts, investors can estimate future cash flows with greater confidence. That level of financial predictability reduces uncertainty in valuation models. Infrastructure and utility-style businesses also benefit from this trend. Companies operating data centers, fiber networks, energy systems, or logistics infrastructure often generate stable revenue through long-term agreements with customers. These contracts can last for years or even decades, creating dependable cash flow streams. Institutional investors such as pension funds and insurance companies often prefer these types of businesses because they align with long-term investment horizons. Another reason predictable companies are attracting higher valuations involves operational efficiency. Businesses that deliver consistent performance often rely on well-established systems and disciplined management practices. They focus on maintaining reliable service, managing costs carefully, and optimizing operations over time. These companies may not grow explosively, but they often deliver steady improvements year after year. For investors seeking long-term value rather than short-term excitement, this type of operational stability can be extremely attractive. Market volatility has also played a role in changing investor preferences. Periods of rapid market swings tend to make investors more sensitive to risk. Companies with uncertain revenue models or highly cyclical demand can experience dramatic changes in valuation when market sentiment shifts. Predictable businesses tend to experience less extreme volatility because their financial performance is easier to forecast. This stability can make them appealing during periods when investors are trying to protect capital rather than chase speculative opportunities. Another important factor is capital allocation discipline. Businesses with stable cash flows often have more flexibility in how they deploy capital. They can invest in growth initiatives, return cash to shareholders through dividends or share buybacks, and maintain strong balance sheets. Companies with unpredictable revenue streams may struggle to maintain this balance because they must constantly reinvest heavily just to sustain growth. Predictable businesses often demonstrate stronger financial control over the long term. Technology is also influencing the rise of predictable business models. Advanced data analytics allows companies to better understand customer behavior, forecast demand, and manage operations more precisely. This improved visibility allows businesses to create more reliable service models and pricing structures. For example, subscription platforms can track user engagement and adjust pricing strategies to maintain stable revenue growth. Digital infrastructure providers can forecast data traffic trends and plan capacity expansions years in advance. Technology is making predictability easier to achieve and maintain. Another reason investors value predictability is psychological. Financial markets often go through cycles of enthusiasm and caution. During periods of optimism, investors may focus on high-growth opportunities with uncertain outcomes. But during more cautious periods, reliability becomes more valuable. Investors may prefer businesses that consistently deliver modest but dependable returns rather than companies promising dramatic growth with uncertain execution. In many cases, predictable businesses can compound value quietly over long periods of time. Even modest growth combined with stable margins and disciplined capital management can create significant long-term shareholder value. The shift toward predictability does not mean that growth companies are no longer attractive. Innovation and expansion remain critical drivers of economic progress, but investors are becoming more selective about which growth stories they believe. Companies that can combine growth opportunities with clear, reliable revenue models often receive the strongest market support. In other words, the most valuable businesses today are not necessarily those promising the fastest expansion. They are often the ones that can deliver growth in a way that investors can understand, measure, and trust. As markets continue evolving and economic conditions remain uncertain, predictability is becoming one of the most valuable qualities a business can offer. And that is why investors are increasingly willing to pay a premium for companies that deliver consistent, reliable performance year after year.